Okay, good morning, everyone. This is Colin here. Thank you, everyone, for coming. This is a video for our SMT graduates. We just want to go through a bit more systematically about the candlestick patterns and how you can use candlestick patterns to help you in your own trading and analysis. This webinar will be about 30 minutes. Okay, basically we cover the different basic candlesticks, which are also the most important candlesticks you can know. Okay, there are so many hundred of candlesticks. Okay, I believe these are the few basic candlesticks that everybody must know, and I believe that if you master them, you can really help you dramatically increase your probability in trading. Okay, so let us begin. This is the first pattern. Okay, so we will cover a few patterns. We will start from the basic one candlesticks to two candlesticks to later part the three types of candlesticks. Okay, so the first candlestick is what we call a doji candle. Okay, you can see from this screen, this is a doji candle, and basically the doji candle is formed when the open, okay, and the close are very or the same or very close to another. So basically the open and close is the same. So what happens is that there will be a very small body over here. So just to recap for those people who are new to candlesticks, basically this is the high price and this is the low price. The open and close price is the same over here. Okay, the length of the candlestick is not important. Okay, the Japanese indicate that in this doji candle, where doji candle happen is when the bulls and bear are conflicting. Okay, however, I mentioned in the last webinar that it's not necessary that the reversal will come. I.e., let's say we have uptrend. Okay, prior to this doji candle, let's say we have uptrend. It is not necessary that after this doji candle or indecision, the next will be down. Okay, it is possible. It's entirely possible. In fact, based on statistics, it's a 50% chance that it will go the other way. That means, let's say, example, we have an up candle, we have a few up candles followed by this doji candle, and then after that, subsequently, further up candle. Okay, so it is entirely possible also. So major thing to take note is, let's say, example, this doji candle were to happen, and let's say, example, if you look backwards and you can see also prior resistance, okay, then you know that right now we have hit another resistance level. Okay, so the doji candle and the prior resistance is at the same place, at the same price. Then we know that hit a major indecision point. Okay, so at this point, it is possible that it breaks down. Okay, and go back into that inside the resistance, or it can break out and move above the resistance. Okay, so just take note of that. Okay, candle give you confidence of when you look at the support resistance, or in this case the resistance, that this is a valid breakout. Okay, so that is for doji candle. Okay, the next candle is what we call a gravestone doji, which also cover in the bottom. Okay, gravestone doji happen when the open and close occur at the low of the day. Okay, at the low of the day, the open and close and the low is the same price. So open, close, low is the same price, and usually is found in the market top. Okay, so what happened is prior to this candle, usually the candle are up. Okay, there will be a few candles up before this candle, and then after that coming down. Okay, so what happened is this doji candle, what happened is the open is this price, it trades higher, and then subsequently they close back lower. This also represents to you that there is selling pressure above this at this body over here. Okay, so chances are, if you see a series of up candle followed by a doji candle, likelihood if there is a next move down, and if it breaks prior day low, which is the low of this candlestick, then it's possible to do a short trade from here. Okay, occasionally this candle can also be formed at the top, at the bottom also, but more importantly is at the top. Okay, so example, if you see a few up candle, you see this gravestone doji. If you look backwards and you see prior resistance, and then subsequently you see a breakdown of this prior day low, this low price, then you can actually do a short trade, a down trade, and put a stop above that resistance point. Okay. So the next one is what we call a long leg doji. Okay, a long leg doji is similar to the doji. Okay, what it means is the open and the close are near the center of the trading range. Okay, and it's basically a long candle. Okay, so basically what it means is indecision again, similar to the doji. Okay, so one more distinction. Okay, you can see from here. Let's say example, if you have a long leg doji and you were to do let's say a long trade. Okay, let's say prior trend was downtrend. The prior trend, the prior few candles was down, followed by this long leg doji. Okay, next and then let's say example you look backwards as there was previous support, and this long leg doji represent that there is buying pressure on the bottom, and what happened is subsequently the next move is it breaks above the prior day high, okay, of this candle. You can do a long here, okay, above the prior day high. Challenge is over here. If you have a long candle over here, the stop loss will be quite far away. So what you want to do is maybe you can use half, okay, half of this long leg, 50% from this long leg as the stop loss instead of at the day low. Okay, so this is what you can use this strategy. Okay, instead of the full candle, you can use 50% of the candle. You can also apply this to either your long black candlestick or long white candlestick. The same principle apply. 50% is like the pivot point, okay, between these two these long candles. Okay. Okay, so we have finished the one candles. I believe these are the most essential one candle that you can know. Okay. Besides this this long candle, there is the long white candle and the long black candle. Basically, what it means, the long white candle means to say that the price is bullish. Okay, it's going heading up strongly, and the long down candle or the long black candle is bearish. Okay, it's heading down lower. Okay, so after that, there is the next one. We have the two candlesticks. Okay, the two candlesticks. The first one is what we have is the bullish engulfing. Okay, bullish engulfing. What happened if you look over here, the open is the top here. Okay, the low is bottom here, and then subsequently the next day it breaks below the prior day low or even the close. Okay, it went below here, it gaps down. Okay, and then subsequently what happened is during the day it went down and then it went up and then it closed above the prior the current day low price and the current day open price. Okay, so what happened is this bullishness, okay, after the sell down, usually this happens when a candlestick is coming down, it's a sell down, and subsequently the bullish pressure or the buying pressure becomes so strong, it overcomes the selling pressure. Okay, that's why it's called a bullish engulfing. The whole white candle engulfs the black candle. Okay, so this is what we mean by a bullish candle. Okay, if you have any questions, you can type out in the chat box and then I can answer your questions at the end of the session. Okay, so if you go through, you have any questions, just type down and then we can go through them later. Okay, so this is for bullish engulfing. Basically, this is a bullish candle. What it means is prior to this bullish engulfing pattern, chances are that there is a downtrend, okay, or there are a few candles down, okay, down, and then the final selling pressure when people get down, when it sells down and get down, and then subsequently the buyers come in and engulf the bullish candle. That's why then it's after this. Okay, this is a bearish engulfing. Bearish engulfing is the opposite of bullish engulfing. Basically, the prior trend is going up, okay, followed by a gap up, okay, a gap up, and then closing below, okay, engulfing the this bullish candle. Okay, so it's the other way around. Okay, right now what happened is the bear is overwhelming the bulls, and the next move will be down. Okay, will be down. Okay, so what are the ways to actually trade this pattern? Okay, there are many ways to trade this pattern. One way is to break below the, for example, you have a series of up candle. Okay, you have a series of up candle followed by a gap up. Okay, when a gap up, that means there is a fear of losing out. Okay, people are running in and rushing in to buy the stocks. Okay, gap up, and subsequently it breaks below the high. Okay, if it breaks below the high, and then if we look backwards, there is a previous resistance here. It gap up and breaks below the high of the prior candle. You can do a here. You can put a stop loss above there. Okay, this is one of the pattern that you can do. Okay, so second way you can do is wait for the candlesticks to engulf, okay, and breaks below the low, okay, then that is your second entry that you can do. If this is only after you have a series of low candle up, okay. And the third way you can do is you can actually wait for the day close. Subsequently, the next day you can also do a short. Okay, so these are a few ways that you can do according to their risk. Okay, if you put a short over here, then your stop is over here, your stop loss is high. Okay, if you do a short over here, your stop loss become bigger. Okay, but it's in a way more you see more things already. Okay, subsequently, and then if you see the bearish candle and then you short the next day, even though you short later, but you have already seen the bearish engulfing pattern forming. So it's a risk reward kind of thing. Okay, so the higher the potential reward, let's say you short it earlier, higher potential reward, there's a higher chances of being wrong also. But let's say example, if you are shorting it later, then your chance of being right is higher also. Okay, so this is bullish engulfing. Okay, for bearish, dark cloud cover is similar to the bearish engulfing over here. It's just that the dark cloud cover, it doesn't close all the way below the bullish candle. Okay, what happened? It closed about 50%, from the prior day up candle. Okay, so this is a strong up candle. Usually at this kind of pattern is prior trend is usually a strong few days of uptrend followed by a dark cloud cover. So a dark cloud is candle also. So the trading strategy again is the same. Okay, you get a short. If it gaps up, okay, and then close, start to break below the prior day high, you can actually do a short, or you can actually wait for it to close to do a short. Okay. Then the next one is piercing pattern. Piercing pattern is similar to bullish engulfing, which is this one, bullish engulfing. Instead of engulfing the whole bearish candlestick, it only engulfs 50%. Okay, so it goes all the way down and it closes above 50% of the black candle. So this is considered piercing pattern. This is a bullish pattern. The prior trend should be down, and then the next trend, if let's say this reversal pattern were to happen, the next trend can be up. Okay, so again, I mentioned that you can actually use this in conjunction with a support resistance, in conjunction with even moving average. Let's say example, you look at moving average, you can also use them and to help to get the trend. Okay. The next one is hammer. Okay, hammer is when either this kind of hammer or this kind of hammer, the color of the candles, the body is not so important. More important is to look at this long candle over here. Okay, this long candle over here usually is at the bottom of the downtrend. That means it is coming down, 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 and then you see a hammer pattern over here. So what happens again? There is that buying pressure from here, then buying pressure from here, and then subsequently it close positive, or if there's price pressure from here, subsequently it close negative. You can do a trade. Okay, if let's say the next move is up, okay, prior trend is down, you see a hammer pattern happen, and then next trend is up, you can actually do a long here, put a stop, either do a stop below the low, or you can do it halfway if the candlestick is too long. Okay. Okay, so we finished the two candlestick patterns. Okay, now we go to the three candlestick pattern. This is the morning star. Okay, this is a three morning star pattern. Okay, basically you need to understand how it works. The open is over here, close is over here. Next day down. Okay, it gaps down. Either it gaps down here or it gaps down here, doesn't matter. Okay, and then the next day subsequently it rises above. Okay, it go back above this price. So this is called a morning star. Okay, so there are a few things to take note. Number one is this candle, whether it's black or hollow, it doesn't matter. Okay, whether it's hollow or it's solid, it doesn't matter. Most important, you have a down move and followed by a smaller candle and then an up move from here. Then this is considered a morning star. Okay, it's possible also that this is a doji. Okay, this is also a hammer. It's also considered a study of these three patterns. Okay. Last one is what we call the evening star. Evening star is basically just the reverse. Okay, we have a up move here followed by a gap up or a bullish candle, and then subsequently next down it gaps down, and then a bearish candle. Okay, so this is considered bearish. Okay, this is considered bearish, and this isolated candle over here is considered a evening star. Okay, you can use this also for doji. Okay, let's say example doji happen, gaps up and then it gets down again. This is considered a bearish pattern too. Okay, so there are many examples of this kind of pattern. Okay, maybe we can just go through a few just to let you know. Okay, this one we will not cover this time round. Maybe next time we will cover. Okay, so okay, so what is candlestick pattern? Candlestick pattern, like your microscope in the market. You can use that to actually help you to understand or predict what is the subsequent, maybe next 3 to 5 candle, what are the subsequent move, okay, in the candlesticks. Okay, so for example, we look at STI. Okay, this is example of STI charts. So what are the things that we can recognize or see from here? Okay, remember again mentioned that doji candle. Okay, this is a doji candle. Okay, this is the doji candle. Okay, so the prior move is up downtrend. Okay, prior move is downtrend, and then followed by this doji candle. You can actually do a long here and then do a stop below that. Okay, of course you can put in your other tools like your support resistance and all your other tools to help you to look at whether is there a good support. Okay, in this example, this is actually support over here right now. Okay, so this support and followed by a reversal of this down move from here. Okay, this is an example of a doji candle. Okay. Okay, doji candle can also happen in here. For example, this is a doji also. Can you see my screen? Okay, you can also see that this is also a doji candle, and subsequent move is downtrend. Okay, so there's a down move followed by a pause in the market, and then followed by another down move from here. Okay, so this is considered a bearish pattern as well. Okay, it's considered a bearish pattern as well. Okay, so what happened is there's a pause, and subsequently the move is still down. Okay, so understand that a doji candle does not mean that it's always a reversal. It's possible that it's a continuation. In this case, the pause will break downwards. Okay, so what you can do is actually you can use this pattern to actually trade. Okay, to actually help you to trade. So other things to take note is like your bullish and bearish engulfing. See whether we have any pattern like that. Okay, so sometimes you can even understand that some of these patterns you can understand some of these patterns just by understanding how candlestick works. Okay, example over here we have a down move. Okay, bearish candle, bearish candle, followed by a gap up. Okay, so a gap up will give you a clue that the market may be reversing, and then subsequently you have a up candle again. Okay, so this is an example of understanding how candlestick pattern works. Okay, so from here you can actually see okay, for example, you can see okay, let's run this as a doji candle. Okay, so from here you can see that there's a down move here, open high, close low, open high, close low, open high, close low, followed by a gap up, and then subsequently close above the high of the previous day, and then the stock start to move up again. Okay. Similarly, from here you can have a gap up. Okay, followed by a close down, so you know that the next day at least is a down move. Okay. So this is how you can use candlestick pattern to predict maybe the next 3 days. Okay, next 2 to 3 days what the price is going to be like. Again, you do not use this on its own. I suggest to use this together with the substance, with your moving average, okay, with even your trader's GPS to help you to have a better read of the market. Okay, so this is the end of our webinar. Thank you so much for those people that are here. I'll be recording this and uploading this onto the members area. Hopefully, be useful for you in your trading. Okay, if not, then have a good Monday. Thank you. Bye.